You're listening to The Weekly Edge, your straight-talking guide from industry experts on what's really moving the fixed income markets, here in Australia and around the globe. Brought to you by Gilt Investments. The Weekly Edge is your go-to podcast for sharp, actionable insights into the forces driving bond markets. Each week, your hosts Alastair Healey and Richard Brennan take you on a fun and insightful romp through the financial markets. With their no-nonsense style and deep experience, they help you cut through the noise. Alastair's deep market smarts and Rich's trend-driven mindset make for the kind of conversation that keeps investors sharp, and always one step ahead. Quick hits, smart takes, real perspective. Let's dive in.
G'day, and welcome back to the Weekly Edge. It's Thursday, May the 22nd, and this week, the headlines are heavy and the ratings are falling. From sovereign credit to senior deposits, Moody's has taken the red pen to the US again. And just when you think things can't get more crowded in the debt parade, here come the banks. So Al, how's your week been? Is AAA still the gold standard, or are we entering the era of average at best?
Yeah, good morning, Richo. My week has been, I guess, very similar to the last couple of weeks and months where it's very hard to know what's going on. So it's been fantastic. And I would probably agree, average at best is the catch cry at the moment. Hasn't changed.
Perfect. So, folks, strap yourselves in. It's time to explore the tangled web of downgrades, debt ceilings, and disappearing confidence. So let's kick off with a big one, Al. Moody's has officially downgraded the US credit rating from AAA to AA1, citing rising debt burdens and the government's inability to rein in fiscal deficits. But that wasn't all. Moody's also cut deposit ratings for major US banks such as Bank of America, JP Morgan, Wells Fargo, and State Street. They all got hit.
Yeah, look. Ratings is one of those things that no one really pays too much attention to on the street or with corporates or companies. You know, fund managers do because their policies are based on ratings. And also the rating agencies don't help. From an institutional point of view, you have to pay about $100,000 in order to get rated. And then they have these sort of points of difference, like they're an American company and small companies will never get a good rating compared to a large company, things like that. So it sort of gets overlooked. The professional markets, definitely they have to stick to policies because they're managing other people's money. But the people on the street and generally companies don't know much about ratings at all. But ratings has a big influence on the market. If you're part of the market, you've got to be aware of ratings. Like these rating agencies haven't helped because they ban retail clients, getting access to ratings. So it's very hard unless you want to sit down and read someone's balance sheet, which is pretty hard, and understand all the ratios to try and get a feel for the risk you're taking if you buy your bonds. You've got no other way of measuring the risk unless you embrace ratings. So ratings are very, very important. And then, ratings are monitoring things all the time as the market goes along. So if things change, then the rating has to change. The best rating is AAA, and it goes down to the lowest investment grade rating is BBB minus. And where a lot of people get confused also, there is ratings for short term and there's ratings for long term. So you can have some companies will have a good rating for short term, but their long term rating is not so good. And you can have the reverse, short term they might have some difficulty, but long term still have a good rating. So you've got to understand that. Then BBB minus, it goes down to about C, I think is the lowest, or F probably, or D I think it is default. So people don't, and people that should know get it confused. A lot of councils and places like that don't understand about ratings, put in a long-term rating, but they never invest their money past 90 days. So it's a grey sort of very important area, but people don't pay too much attention to it or don't understand it as much as they should. And then the rating agencies also charge for it. So the rule of thumb always used to be, no company can have a better rating than its government. And then if you look at what's going around the world, the ratings are looking at things like debt levels and revenue levels and, the risk. They're trying to assess the risk, not only just countries, but products and banks and institutions. They're assessing everything based on their cash flows and their profitability and the problems they have. So, if you look at Australia, or if you look at America, it's just been downgraded by Moody's, and basically because their debt level is blown out and it's very difficult for them, or at the moment they're finding it hard to rein in their costs, even if, Elon Musk has had a pretty good crack at it, but they're absolutely hating him for doing it. So that makes it almost impossible for companies to try and rein in their costs. With their debt levels are up around 36 billion, and still nobody wants you to touch the costs. So that's why they're getting downgraded. So if you bring that across to Australia, it becomes, the big question now is who's next, really. Yeah. If you look at Australia, we've got 868 billion at federal level. And then all up, if you include the state governments and any other, there's lots of other debt around that you can't find. But what I could find last night going through the figures is about $1.5 trillion worth of debt between the state governments and the federal government. And if you said to anyone, I think they're writing in or striking in Victoria because they're going to push taxes up. Well, that says it all. Bang, right there. Like, this country is going to have difficulty and governments are gutless, really, because they're too scared to do it, to rein in their costs in order to get their budgets back in order and things like that. So it's a big issue.
Listen, interestingly, I noticed that Standard & Poor's and Fitch had already previously downgraded the US. So Moody's was the last holdout, and they were the ones that recently put it to AA1. But they're not pulling any punches, are they? Back in the US, they're obviously very concerned that the US aren't in a position to fix their deficits.
Yeah, that's right. That, it has a massive effect on the cost. So it's risk return. So if your risk goes up, then, if you're investing your money and you're taking more risk, you expect a better return. But from a borrowing point of view, if the risk goes up, means you've got to pay more for your money. So that's why it's really, really crucial.
Something I don't understand is that it's always been classed as a US bond market as basically the risk-free asset that benchmarks the rest of the world, because the US can print money. But Moody's, Fitch, Standard & Poor's, all downgrading. Does that mean that the printers are turned off? What does that mean?
Printers aren't being turned off. And America, the risk-free is really in relation to the government. The government is always deemed in any country the risk-free level. So wherever the government borrows money, then the rest of the market prices against the government. So if the government loses its rating, and that's why the banks, one of the comments was that all the banks have been revalued as well, or re-rated as well by the Standard & Poor's. And that's coming back to that logic that no company should have a better rating than its government, because government is the risk-free for that country. And then, yes, the American market, because it is the big market and because everyone borrows money from America and has a massive influence on everybody, I guess lots of countries are priced against America.
So this will have a flow-on effect globally in probably lifting or lowering the credit ratings of most countries?
Definitely. It'll be a matter of time, because S&P and people like that will go through. You've got the biggest economy in the world that's probably, it's now AA plus in Standard Poor's eyes. And then you got a country like Australia, for example, that's struggling to get its budget back in order. Its revenue, I think last year or in March, was 60.2 billion, and its expenses were 61.2. So we've got a negative cash flow, and we've got huge amounts of debt. So you wonder how long we're going to be sitting there with our AAA rating.
So looking at Australia, so we're sitting at around about 4.4%, but if we get a downgrade from our current AAA, the whispers are getting louder regarding that. So what's your view there? Are we going to get a downgrade shortly?
I personally think we're living on borrowed time for sure. And if you go back prior to 2008, we were AAA rated. We're still AAA rated, but America was AAA rated as well. So there's also size involved. And back then, when we were both AAA rated, Australia had to pay 1.5% over the Americans to attract money our way. Well, two things: to keep the money we'd already borrowed from overseas, but also to attract new money to come across to fund our budget deficit. So if we get downgraded, it goes down to AA plus, which puts us in line with America again, which then makes, logic says we then have to pay 1.5 over them, over their cash rate to attract money or keep the money that we've got. And of that 800 odd billion we've got from federal government debt, I think about 40% of it comes from overseas. So we have to keep our interest rates and our risk and price for money in line with what's going on around the world. Otherwise, they'll pull it out. If they're not getting a good enough return in Australia, but the risk has gone up, then guess what? We lose the money. It goes to America. So that, and if you look at things like, the debt level when Kevin Rudd got into Australia, I think the federal government had $90 billion worth of debt. It's now got $868 billion. So at that stage also we had low unemployment. We had high employment. Tourism was running well. Education was running well. Construction was running well. Mining and farming were all doing well. Now we've got 860 odd billion of deficit. I think our unemployment is still good. Employment is still good. The tourism industry is probably struggling to get back to where it was. Construction is the same, trying to get back to where it was. So it's a little bit down. Education is definitely down. So mining, I think, is flat and farming is okay. So our revenue side is not looking so good, and yet our debt just keeps blowing out. So you have to ask, how long are we going to hang on to that AAA rating? Yeah. Particularly when you look at China and you look at we rely on China for, all our exports. That's where we make our money from, all our exports to the world. China's a big player there, and if tariffs are going to slow them down, then we're in, they'd be looking at us for sure.
Speaking of China, okay, we mentioned this last week, but transparency continues to evaporate. Last week, we saw more data suppression from property sales to population metrics. So it's getting a bit more cloudy over there, is it, Al?
Yeah, I mean, I guess not that, we're always trying to gang up on China, but at the end of the day, they are the second biggest economy in the world. So, and America's the biggest. So between those two, you've got China's the biggest manufacturing country in the world, and America's the biggest consumption country in the world. America is now run by someone who's pretty loose and wants to put tariffs on everybody, which is going to turn their consumption upside down. And China, is all about save face. They don't want to tell anyone what's going on, but you suspect there's problems over there. So they, being a regime, so to speak, they can do whatever they like. There's no opposition that's going to tell them they can't do it. So they can play games as much as they like. So if you look at, last week that I put into the charts that I found, they've stopped reporting on toll road debt balances, national land sales, no numbers of cremated bodies, unemployment rate for 16 to 24, new stock market investors, soy sauce productions. They're all statistics that people look at because it's hard to know what the economic figures are in China coming out because they've got this air of, they've been manipulated. So people zero into things trying to find out what the hell's going on. It's like looking at the lights are on in a, if you want to know how many units have been sold in a block of flats, you look at the lights, whether they're on. It's the same deal with China, but they're now starting to stop. They're now not printing some of those statistics. So you've got less of an idea of what's going on, even more so. So putting aside all the politics and the geopolitics, you've got the two biggest economies now that are really, really hard to read of what the hell's going on.
And they're closing the blinds of their units.
They're closing it, and that cannot be good. If you had a mortgage and you went to your bank and dodged up your income statement, they would pull the loan on you. So unfortunately, China's got a lot of debt to the Western world, and they're not giving them any information. So it really is quite what's the word? It's damaging, if you like. It just doesn't add to confidence, and that's what runs the economy.
Well, let's move on. We were talking about China's debt before, but now let's look at this figure of world debt, $324 trillion avalanche. So debt isn't just a US problem or a China problem. So we're staring down now at 324 trillion in outstanding obligations worldwide. That's up 7.5 trillion in just 3 months.
Yeah, yeah, it's mind-boggling when you start looking at the figures. And again, you can get people to just dismiss it and say it's all just propaganda, and you're just sort of gluing it up and look at the assets and all that sort of stuff. But putting my old banking hat on, you never, you always look at the gross amount. You don't net things out, because if someone falls over, you've got to look at the gross amount of money you've lent. And it's the same. We can look at all the assets that are backing all these loans up, but they're really, land assets and things like that countries by and large can't sell. And if you've got countries around the world that are geared up, way beyond their means, and I think right now, pretty much most countries that I'm aware of have got, huge amounts of debt. I put it in my newsletter the other day. I think it's something like 60 odd countries out of about 130 that have got a debt to GDP figure that's over 50%. And there's about 20 to the top 20, I think, are over 100%. So everybody has got bucket loads of debt. So if the world's heading towards a recession, it's just going to get incredibly harder and harder and harder for anyone to be able to service their debt.
So we're putting a shackle around our future generations' necks regarding future debt obligations?
I think so. The debt level's huge. Unless we can all, right now, which is probably the reason why everyone's starting to headbutt a bit, and geopolitics is sort of starting to, get aggravated. It's because of all this debt and all the economies. And you've got different sorts of economies, from regimes and democracies. Water doesn't mix with oil, so they're starting to headbutt. So you've got a lot of issues right at a time where most countries are highly geared. So you just wonder where it's all going to go. And mixed into that, which is sort of the underlying theme in today's podcast, is the ratings. The ratings are trying to tell everyone, we've got too much debt. So if they're downgrading America, the biggest economy in the world, that's saying something. You've got to pay attention to it.
So the key to this is feed the kids well, because they're going to be very busy in the future.
Teach them how to, grow potatoes. It's going to get tough. It just depends on how it all pans out. If one by one each country was allowed to pay down the debt, it wouldn't be a problem. If we could all get on and, work together to pay down our debt, it wouldn't be so bad. But that's not going to happen, and no one does. Like if you look at the American debt, their economy, I think, is about 22 to 23 trillion. Their debt's about, say it's 35 trillion. If you knocked off a few noughts, that's like saying, you've got a mortgage of $350,000 whilst you earned, $250,000, income for the year. That just wouldn't be a problem for any bank. They'd want to lend you more money, but it's not that. The problem is when you lose your job. If you've got a mortgage of 350 grand and you're unemployed, then it becomes a problem. And that's the same, that, using that as an analogy, globally, if we all start fighting each other and we're all heading towards a recession, that's akin to sort of a country losing its employment. So they've got less income to service their debt. So that's the issue.
All right, Al, enough tears for the day. Let's do a wrap up. So here's what we're taking away from this week. Moody's downgraded both the US and its biggest banks. Debt levels are rising faster than confidence. Central banks are trying to manage optics with policy tweaks. Australia is steady for now, but exposed. And China's data strategy is increasingly, if in doubt, black it out.
Yes, absolutely. All of those are big issues. Moody. So for me, for that first point, it's really a case of who's next. It's a big problem if the biggest economy in the world just got downgraded. That's not good. Debt levels are definitely, you either pay off your debt or you write them off. So I can't see anyone writing the debt off yet. If you start going down that road of writing debt off, then where are you? So people are going to have to pay it off, and it doesn't come down unless you pay it off. So full stop. Central banks, yes, they're tweaking it. But see, the thing is, most people think central banks run the economy. They don't. All they've got to do is look after unemployment and inflation. The government is the one that's running the economy, and the Reserve Bank just reacts to the policies that are put in place. So even though everyone thinks it's up to them, it's not. Australia's sitting there, hand on my heart, I think we're kidding ourselves a little bit. We don't manufacture a cracker. We sit here and we just export everything, and most of our export countries are, probably slowing down. So we've got massive amounts of debt and we're earning less money. So it can't be good in the long run. And China, yes, that's a big problem. The Western world has lifted them up and now they're just acting like a regime and doing whatever they want, I guess. And they, not letting people know what the figures are and hiding figures is just not good for anybody.
All right, folks. Well, that's it from us for the week on The Weekly Edge. Thanks for tuning in. And as always, watch for the edges.
Absolutely. Log in and click in and I'll send it to you if you ever want it. But yeah, another week. Let's look forward to next week. Hopefully it's better. Thanks, Richo.
Thanks, Al. Bye, everyone.
Thanks for tuning in to The Weekly Edge. At Gilt Investments, we're here to help you navigate the fixed income markets with clarity and confidence. As an Australian fixed income brokerage licensed to advise and deal in fixed income securities, our experienced team is ready to help you reach your investment objectives. We hope you enjoyed this week's Edge and that it helped keep you in the loop and ahead of the curve. Until next time, stay sharp, stay focused, and we'll see you on the next episode of The Weekly Edge.